Were you surprised to learn that the Fed may not be done raising rates? Or that tech stocks are dominating 2023 after such a dismal 2022? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the second quarter of 2023. The date today is June 19th, and today we'll be discussing these and other factors driving stock and bond markets. My name is Paul Latta. As in prior slideshows, I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is available on our website at cedarrivercapital.com. Today we'll begin with a top-down discussion about the recent market action. We'll then look at the macroeconomic backdrop to put more context in the market discussion. Then we flip to a microeconomic view and look at a handful of key industry-specific drivers. And then we'll finish with a handful of longer-term observations and conclusions about the investment landscape. The S&P 500 has done quite well over the last 5 years, as you can see here. Good news is that the S&P is up 74.2% in the prior 5 years. Last year was the only down year, being down about 18%. But the S&P is up about 15% so far this year, and we are again encroaching on new highs. The bond market has not been so healthy given the Federal Reserve's rate hiking campaign. Short-term and long-term bonds are both seeing higher rates compared to prior years. The chart on the left is the short-term one-year Treasury, which has been tracking overnight Fed funds quite closely and have lifted from near zero just after COVID to the present level of 5.22%. The chart on the right is for long-term 10-year Treasuries. Long-term rates are also higher, though not quite as tightly correlated with Federal Reserve overnight rates. Indeed, the upward trajectory of long-term rates lagged the move on short-term rates. The yield on the 10-year Treasury is only 3.77%, which is well below the 5.22% of the one-year Treasury. This yield inversion has been with us for a little over 9 months right now. The rapid rise in short-term rates and slower rise in long-term rates has resulted in a sizable yield curve inversion. As shown here in green, the yield on the long-term bonds going out, say, 5, 10, 30 years on the right-hand side of the chart is lower than the yield on the short-term bonds at the left-hand side of the chart, 0 to 3 years. Yield curve inversions are not very common and are generally regarded as a recession indicator. The yield curve a year ago, as shown in yellow, was not inverted, but was a normal upward sloping curve. Most investors looked at the spread between the short-term 2-year Treasury and the long-term 10-year Treasury to measure the size of the inversion. Today, that inversion is a minus 95 basis points. That's near a 40-year record negative. With the Fed likely to raise rates again in mid-July, the inversion is likely to remain. Speaking of the Fed raising rates, it does indeed seem probable that the Fed will raise rates another 25 basis points at its upcoming meeting in July 26th. Indeed, the Fed narrative at the June meeting hinted at structural inflation and the possibility of 2 additional rate increases. This table is from the Chicago Mercantile Exchange and looks at implied probability of additional rate increases based on Fed funds futures, a clever approach to deriving consensus probabilities. Based on the futures activity, the consensus is that the Fed will raise rates only one more time, and it will be at the next meeting on July 26th. Specifically, as you can see in the top line in the blue square, there's a 75.6% probability that the Fed will bump rates from the present level of 500 to 525 basis points to a higher level of 525 to 550 basis points. If you then track the blue squares lower for the subsequent meeting dates, it appears the most likely scenario is that the Fed will hold rates through the rest of the year, and then it will cut rates by another 25 basis points at the January 2024 meeting, and there will be additional rate decreases throughout the course of 2024. The Fed is not the only central bank raising rates. After all, COVID was a global pandemic, and most central banks around the world are wrestling with inflation due to recovering demand amid constrained supply chains. Also, central banks are motivated to coordinate and to avoid currency movements arising from interest rate disparities. Only 2 central banks of size are off script and not raising rates: Bank of China, due to the recent reversal of the COVID zero policy, and Bank of Japan, mainly due to its history of deflation. Back to the stock market, the bulls are back in the driver's seat in the market at present. The main area of enthusiasm for bulls is the idea that the Fed's rate hiking campaign is very close to done, and the economy is headed actually for a soft landing. Inflation at 4% last month is certainly better than the 9% peak last June. Additionally, bulls will highlight the money on the sidelines these days with money market deposits near record levels. Also, China is finally putting COVID in the rearview mirror, reversing its COVID zero policy, and that ought to loosen up many of the supply chain issues. Stock market valuation is still relatively reasonable at a PE of 19 times forward earnings, which is about a point above its 10-year average. And of course, American ingenuity, innovation, and invention continue to drive capital growth. Bears, in contrast, will cite three areas of concern. First, while the Fed may soon be tapering, the Fed is still not done yet. There are areas of structural inflation where prices continue to lift. And even if the Fed stops raising rates, that does not mean the Fed will be cutting rates back to near zero anytime soon. Rates are really high today. The ongoing high rate environment will keep the pressure on rate sensitive industries like home and car purchases. Second, there is the risk to earnings forecast, a risk which magnifies with declining inflation and with higher rates. Third, while the market PE ratio is in line with historic averages, maybe slightly above, it is not in line with the higher rate environment. In theory, if you double interest rates, the PE should be cut in half. Lastly, the stock market valuation is not including any discount for geopolitical risk, yet we are in a world with heightened geopolitical risk emanating mainly from the Russia invasion of Ukraine and to a lesser extent the China-Taiwan tensions. Returns by sector mainly reflect sizable moves in the 7 mega-cap stocks: Apple, Microsoft, Amazon, Google, Nvidia, Meta, and Tesla. There seems to be a shift in the 10-year-old FANG acronym Facebook, Apple, Netflix, and Google to update and slightly broaden the narrow group of most favored names. And we are hearing the group increasingly referred to as the Magnificent Seven. Notably, last year's darling, energy, which did well in the early days of the Ukraine invasion, has been a bit of a dog so far this year as energy infrastructure in Europe gradually adapts to the new norms. This slide puts an exclamation point on the narrow market so far in 2023. Through the end of May, the biggest 5 stocks in the S&P rallied 39% versus only 9% for the overall S&P 500. In other words, the so-called S&P 5 trumped the S&P 495. Why are the mega caps doing so well? Well, 2 reasons. They were oversold in last year's bear market, and with the advent of ChatGPT in December last year, all mega cap tech is roaring on the exciting changes associated with generative AI. So 2023 has been a very narrow market indeed. Not a good market for small caps and not a good market for energy. Returns by style factor so far in 2023 are shown in the far right-hand column. As with returns by sector on slide 9, the returns by style factor mainly reflect the presence or lack thereof of the mega cap consumer technology names, the Magnificent Seven. The style factor with the highest concentration is the growth style, which has nearly 40% of its market cap in the Magnificent Seven. Story stocks, by contrast, are perhaps even growthier growth stocks than the growth sector, but that story stock style factor has none of the Magnificent Seven and hence underperformed. Income was in the basement in the second quarter, courtesy of the higher Fed rates and no mega caps. Value did not hold up well either, mainly on lack of mega caps. This is a chart you don't see very often, an equity earnings yield curve. The yield curve for bonds is indispensable and a common touchstone for fixed income investors, but a yield curve for stocks is rare indeed. Yet it offers the same intuitive paradigm of insight that makes bond yield curves so popular. The challenge with constructing equity earnings yield curves is the subjective judgment in deciding which equities are short duration and which are long duration. The curve here subjectively places utilities at the short end of the curve, the S&P 500 at the medium duration, the XLK Technology ETF as long duration, and the ARK Innovation Fund as the ultra-long duration. Most investors would intuitively agree with these classifications, knowing that equity earnings duration really just classifies how long it will take for the earnings to grow into the stock price. A story stock like, say, MongoDB or Datadog, well, they're priced at earnings many years in the future, whereas a utility like NextEra Power or Duke Energy, well, those are just the opposite. A few observations here of note. First, the most pronounced downward slope was in 2020, suggesting that indeed story stocks were overvalued. But today's slope is closer to average. Second, short duration equities have seen little movement from year to year, perhaps a good reason for retirees to own utilities. Lastly, not shown here, but it is interesting that there is a medium-tight correlation between long-duration stocks and long-duration bonds. The U.S. market has been doing a little bit better than the rest of the world so far this year, up about 15.8%. Perhaps this is another sign of reversion to the mean, given that the US modestly underperformed the rest of the world last year. Europe markets are near the top of the list, mainly on the warm winter in Europe that has allowed Europe to not freeze this past winter despite little to no natural gas coming from Russia. The Mexican market has been surprisingly strong this year, a likely outcome of nearshoring efforts from Tesla and various semiconductor companies amid the geopolitical tensions with China and Ukraine. Brazil has been quite strong, mainly in the second quarter as GDP grows but inflation does not, a Goldilocks outcome. South Africa continues to wrestle with the electricity crisis there and the related downgrades on sovereign debt from S&P and Moody's. And China continues to struggle with emerging from its COVID-0 policy from last year amid challenged real estate markets. Turkey is at the bottom of the list, mainly on Erdogan's re-election and fears about his involvement with a controversial central bank policy. But overall, global market performance is doing reasonably well as we near the midway point in 2023. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin with looking at GDP levels by country. This chart shows the OECD's present economic forecast by country for 2023 and 2024. As you can see, some regions have tailwinds and are at the top of the chart, and others have headwinds, those at the bottom of the chart. India is at the top of the list and continues to benefit as an outsourcing alternative to China, as China is still facing geopolitical uncertainty. But China is actually right behind India, mainly on a likely rebound from last year's restrictive COVID-0 policy. Mexico is fairly high on the list for a similar reason as India, as an outsourcing alternative to China. We'll chat more about the Mexican reshoring theme in later slides. Most countries in Europe are shown here just squeaking above zero for 2023 and just over 1% for 2024. Indeed, the Eurozone is presently in a technical recession as we speak, with 2 consecutive quarters of GDP growth just below zero. Inflation at Europe has been a little stickier, as we'll discuss on the next slide. At a broad level, inflation has lifted higher in 2021 and in early 2022, but has been softening in late 2022 to the present. Inflation has been a little stickier in Europe. Of course, the Eurozone countries are right next door to the conflict in Ukraine and more directly impacted by the huge spikes in energy and food over the past winter. Fortunately, those spikes are now receding. Also, the European Central Bank was one of the last central banks to turn hawkish last year, partly reflecting its reluctance to engage in any quantitative tightening without revisiting the pre-COVID sovereign debt problems. So European Central Bank policy rates at just over 3% are actually well below the 5% plus rate in the US. Yet the elevated inflation in Europe is now forcing the European Central Bank to play catch-up in a more aggressive manner, which of course is weighing on GDP growth in Europe. Good to see Brazil inflation dropping quite nicely. Brazil, of course, has a bit of a checkered history in wrestling with inflation over previous decades. Yet in this cycle, Brazil is one of the model children. China, of course, is seeing near zero inflation, likely related to COVID-0, but could see inflation later this year given the policy reversal. Japan, too, is seeing very low inflation, although that's mainly reflecting its pre-COVID challenges with deflation. U.S. inflation, presently at 4%, is clearly declining from its 9.1% peak last June. Most of the inflation drop is due to lower energy prices, as you can see here. Services inflation, however, remains the main point of stickiness. It did peak in February, but subsequent softening has been very slow to manifest. Shelter cost, not shown on this particular chart, remains high at 8%, down a skosh from its 8.2% peak 2 months ago. Shelter cost is commonly excluded from inflation figures since rental contracts are usually 12-month lease terms, so there's about a 1-year lag in responding to changes in interest rates. Shelter costs going forward ought to drop relatively quickly then. Wage inflation at just under 5% remains elevated but is moderating. Lastly, it should be mentioned that this is a chart of the consumer price index, and it is being paralleled by the producer price index, which is also showing a similar but slightly better slowdown in PPI inflation since peaking in June last year. In our slideshow 2 years ago, we discussed the huge increase in money supply with the Federal Reserve printing money via quantitative easing. Such a massive increase in money supply would ordinarily be quite inflationary. But money velocity dropped like a stone, which offset the inflationary pressure from the extra money supply. And as you can see, the money velocity started to rise in 2022 and in 2023, creating an inflationary impulse. So the Fed has been reducing the money supply through higher interest rates and quantitative tightening, and inflation has been moderating. And our textbook questions from 2 years ago have a textbook answer. Wage inflation is always a point of discussion, since wage inflation is an irreversible form of inflation. Unlike oil prices that go up and down, wages can go up, or they can be flat, but they never go down. The chart here shows wage inflation. Like other measures of inflation in the US, they have been moderating for most of the last year. There are several industries where wage inflation remains elevated, as listed here: leisure, hospitality, health services, retail, all of these industries that were hit hard by COVID. Most of these COVID hit industries are actually seeing elevated wage inflation starting to soften in recent months. However, there are a handful of industries where wage inflation is actually accelerating, mainly education and construction, and these may become problematic over the next year or so. Of course, there's also cold spots of wage inflation: transportation and warehousing. Notably, the recent monthly employment reports have been quite strong, with payrolls increasing well over 300,000 last month and persistently over 200,000 over the last 12 months. The labor market remains strong, even in the face of hawkish central bank policy. This is our last slide on the macro situation, and we cannot ignore the geopolitics today. On the Russia-Ukraine conflict, there have been no shortages of headlines about the various attacks and counterattacks, but the front lines have actually seen very little overall movement since our last slideshow 3 months ago. Recent headlines have focused on the destruction of the Kakhovka Dam and whether it was Russia or Ukraine that destroyed the dam. And Russia was in the headlines provocatively moving nuclear weapons to Belarus. The US and NATO continue to pledge more weapons to Ukraine. While the stalemate seems likely to continue, there is ongoing risk of escalation. On the China tensions, there's been a notable softening in tensions since our slideshow 3 months ago, when the president of Taiwan was visiting the US and China was engaging in large-scale military operations over and near Taiwan. Tensions still remain, of course, as China is reportedly negotiating with Cuba for a military training base there. And of course, the global chip industry is reshoring operations everywhere away from China. So escalation risk remains here as well. We'd now like to move to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. Before we launch into the microeconomics, this slide recaps the 5 themes that we discussed last quarter. Most of these themes are still in play today. In particular, we would highlight the theme in the middle here, the ChatGPT and generative AI, since this theme is continuing to garner headlines owing to its disruptive presence. Indeed, ChatGPT is one of the key themes driving the narrow stock market rally, which is dominated by a mere 7 mega-cap consumer and technology companies. We would also highlight the increasing headlines around the first item on the list, the medical advances in diabetes treatment with the enormous popularity of Ozempic and Mounjaro, and the huge moves in the stocks of the makers of these drugs. The other 3 items on the list, bank failures, war shocks in Europe, and real estate pressures, all 3 have moderated, but of course could recur at some point in the future. Today we would like to highlight 5 additional themes as listed here: overdue medical advances in treating Alzheimer's disease, signs of stabilization in real estate markets, the rise of Mexico nearshoring, the role of transports in today's bull market, and tracking the lag of illiquid investments. On the left here, you can see the sizable moves in Biogen and Eli Lilly stocks, both rising on news of successful phase 3 trial results on treating Alzheimer's disease. The huge move begs the question: has Alzheimer's disease been cured? Well, no, Alzheimer's disease has not been cured, but Biogen and Eli Lilly have made progress. Biogen's drug, Leqembi or lecanemab, was approved by the FDA in January after passing its pivotal phase 3 trial in September last year. And Eli Lilly's donanemab passed its pivotal phase 3 trial in May and is on track for FDA approval in the back half of the year. A little more background on the supply-demand picture for treatments for Alzheimer's disease. These charts basically show there is enormous demand and virtually no supply. The chart on the left shows the US is spending over $300 billion per year treating patients with Alzheimer's disease. That's very expensive, very prevalent, and ultimately it's a terminal disease. Costs are persistently rising. Alzheimer's is an enormous problem. But the chart on the right gives a hint of how difficult it is to find a medicine to treat the disease. Clinical trials in Alzheimer's disease have actually the worst record of any major disease category. Indeed, not a single Alzheimer's drug has passed all 3 phases of clinical trials in the last 15 years. Not for lack of trying, there have been dozens of candidates run through clinical trials, but not a single candidate has made it all the way through, until this year. So it appears lightning has struck twice in 2023, with 2 Alzheimer's drugs succeeding in pivotal phase 3 trials. Do the drugs cure the disease? No, neither drug cures the disease, but they do slow cognitive deterioration. The efficacy is modest, as you can see here on the second column to the right. Over the course of the trial, Biogen's drug slowed cognitive decline by 27%. Lilly's drug slowed cognitive decline by 35%. Both drugs have a possible brain swelling side effect, which in rare cases can be terminal. As you can see on the column on the right, brain swelling is a little worse for the Lilly drug than for the Biogen drug. While slowing cognitive decline by 27 to 35% may not seem like much, it is better than other treatment options that essentially have no effect. Most patients are likely to take this medicine, and there are a lot given the $300 billion in annual Alzheimer's spending. Street estimates for peak sales are in the 10 to 15 billion range. This could prove conservative. As investors, we remain enthused about both Biogen and Eli Lilly stocks. Biogen appears to be the slightly better value here today, partly because the lift in the post-phase 3 market value was a fraction of the lift seen in Eli Lilly. Biogen does have other tailwinds, first mover advantage in Alzheimer's, and there is a treatment for postpartum depression that seems likely to pass phase 3 later this year. We continue to own Lilly too, though Lilly, it appears, has latched on to two potential blockbusters, the other being their diabetes drug, Mounjaro, a treatment that could be even bigger than Ozempic. The valuation on Lilly is pricey, but not out of line with the pipeline prospects. I'd now like to move from the pharmaceutical industry to the real estate industry. Residential real estate continues to face the headwind of high mortgage rates, with national average mortgage rates just over 7% at present. And real estate prices have been under pressure for most of the last year. But as you can see in the chart here, we are seeing a small lift in prices just in the last month or two. Is the real estate downturn over? Possibly, but at the same time, real estate is unlikely to see the appreciation levels like we experienced in 2020 and 2021. A flattish or trading range market seems more likely in 2023 and perhaps into 2024. It is interesting that there are sizable regional differences in real estate markets, perhaps a reminder that real estate has a strong local flavor. Seattle and San Francisco are both seeing double-digit declines, but Florida is seeing mid-single-digit increases in residential real estate prices. Commercial real estate is seeing higher cap rates in conjunction with higher interest rates. Implied cap rates are higher than actual cap rates, but both are higher. Cap rates of troubled sectors, office and retail spaces, are higher than healthy sectors like multifamily apartments and industrial. And like with residential real estate, there are significant variances from region to region. Now I'd like to shift topics again into the Mexico reshoring theme. Mexico is the best performing stock market in the world, as shown back on slide 13. A big driver has been the veritable boom in foreign direct investment, or FDI, driven almost exclusively by the tensions with China and the efforts to reshore or nearshore manufacturing. As shown in the chart here, FDI in Mexico roared 48% higher in the first quarter of 2023. The FDI was broad-based: transportation, chemicals, computers, food, electricity generation, and more. Notably, the FDI investments do not include investments in Mexican stocks. Those inflows are tracked separately. Most FDI is investment into improving existing infrastructure, such as utilities, in order to increase manufacturing capacity. The Mexico market is up about 30% year to date, as shown here in blue. By comparison, the S&P 500 is up about 15%, as shown in yellow. Almost half the gain in the Mexico market was due to the strengthening peso. Specifically, 14% of the 30% gain was due to the currency. The remaining 16% was due to the local stock. Of course, most of the move in the US S&P 500 was due to the move in the 7 mega-cap techs, or the Magnificent Seven. Mexico, in contrast, had a strong performance despite having no mega-cap tech stocks in its index. Not all Mexican stocks are participating. Some names are direct beneficiaries of reshoring inflows, some are not. We would mention a few that do seem to be big beneficiaries of reshoring. The cement company, Cementos Mexicanos, is clearly on the list. The airline, Volaris, also on the list. The 4 publicly traded airports, too. And the industrial REIT, Fibra Prologis, also seems like a good play. These seem to be close to pure plays on the reshoring theme, but we would also mention the Mexico Country ETF, not exactly a pure play, but a simpler way to play the theme. We'd like to switch topics and move away from Mexico reshoring and then take a look at Dow theory, and in particular the underlying constituency of the Dow transports. The old and venerable Dow theory says that we can only be in a bull market when both the Dow Industrials and the Dow Transports are up 20% from their lows. As shown here, the industrials crossed that threshold in January, and the transports followed a month later. But the 100-year-old theory does have shortcomings, since today's industrials include more information and service companies and fewer manufacturing companies. Also, the transports are not as cohesive as perceived, as some track the domestic economy, like trucking and air, and some track the global economy, like rail and ocean shipping. COVID threw another wrench into the behavior of transports, with some modes seeing unprecedented supply and demand mismatch, while others move forward unperturbed. This slide breaks down the freight transports into the four main modes: air, ocean, rail, and truck. The right-hand column shows how useful these modes are as economic indicators, the original intention of the transports in Dow theory. In short, the trucking mode is the closest mode to being representative of the U.S. economy, since trucking does more finished, non-commodity goods all within a domestic network. In contrast, ocean shipping, especially dry bulk shipping, has very little relevance to the health of the U.S. economy. Bottom line, using the overall transports as a proxy for the U.S. economy is a very crude tool. Not all transport modes are in a bull market formation, but all are off their lows. For the truck freight stocks, the average is generally above the 20% threshold, but the median is actually just below. Ocean shipping is clearly not there, but ocean shipping saw the biggest lift during COVID and hence was the most vulnerable after COVID. Freight rates have been in decline for all four modes of shipping, but have flattened in the last few months for all modes with the exception of ocean shipping, both dry bulk and container shipping. The rate stabilization for non-ocean modes is drawing more equity inflows, pushing laggards into bull market formations and assuaging Dow theory skeptics. With the stock market generally in a bull formation, many investors are curious how less liquid investments have been performing. After all, non-liquid investments typically lag liquid investments. As shown here, most of the equity-oriented non-liquid investments have shown sign of bouncing in the last 2 months. We chatted about residential real estate equity bouncing on slide 28, but we're also seeing other equities bounce, including non-listed equities, venture capital, and private equity. In contrast, non-liquid fixed income investments have not really bounced, mainly since interest rates remain elevated. We would like to conclude our slideshow with 2 additional slides with a top-down and longer-term view. This chart compares the earnings yield on stocks to the yield on corporate bonds, as well as the yield on 3-month T-bills. It seems we have a rare compression of yields across all assets. The chart shows that we are in unusual times, as we have a single point of conversion where all three are just over 5%. For most of the last 20 years, stocks have traded cheaper than bonds. This does increase the relative attractiveness of bonds. At Cedar River, we have been using ladders of target maturity bond funds, kind of an easy button approach to getting exposure, but without the illiquidity of a traditional bond ladder. Another reminder that bear markets frequently lead to bull markets, as shown here. Post-trough returns can be significant, with 1, 3, and 5-year return averages of 53%, 87%, and 139% respectively. The stock market has many ups and downs, but patience is a virtue. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.